Hey, yo, welcome back to the channel for Dividend Growth and Alpha Fanatics. In our last video, we covered 3 misconceptions surrounding dividends that I thought investors were still getting caught up in. And in today's video, I thought I'd do a comprehensive deep dive on my largest position in my own personal portfolio, SCHD. Yes, it was one of my favorite dividend funds, just like everybody else. But if just a couple years ago when I first started this position, I understood the principles I shared with you in the last video, I would not have gone so gung-ho for this particular fund. And if you're a young investor in your 20s or 30s with a conviction in dividends as a major part of total returns, I think you should pay attention. But if you don't agree with me on something, then leave a comment down below. Let's get the obvious disclaimer out of the way. I'm not a financial advisor, and this video serves for general educational and entertainment purposes only. None of the information in this video is to be taken as financial advice. Please do your own research and make your own investment decisions accordingly, or work with a licensed professional. Okay. Please don't get me wrong here, guys. I think SCHD is a phenomenal fund, and I don't plan on closing my position in it anytime soon. I mean, I've already accumulated over 1,000 shares, so I might as well keep that dividend snowball rolling. But I think a lot of investors still don't quite understand what they are purchasing beyond the face value of a rock bottom 6 basis point expense ratio, and above 3% dividend yield, and apparent value tilted focus. So let's start with how it actually works. It passively tracks the Dow Jones US Dividend 100 Index. Now, this index has certain extremely strict criteria, the first of which most of you guys are already aware, that the companies must have 10 consecutive years of paying a dividend. Notice that it doesn't explicitly state a minimum yield. We're going to get to that. But easy enough, right? With this first criteria, young, speculative, and unprofitable companies that don't pay dividends are immediately excluded from the index. I'm sure you know this. Let's move on to the next criteria, which is that the company must have a minimum market cap of $500 million and meet the minimum liquidity requirement, or in other words, strict daily trading volume requirements. What is the minimum liquidity requirement? At least $2 million of a company's shares must have actively traded per day on average in the past 3 months. Not your biggest concern there as a long-term investor, but just know that its implications include avoiding companies whose shares might largely be locked away by private equity and potentially vulnerable to share price manipulation, extreme volatility, etc., etc., etc. In other words, it's a good thing. But here's a list of the dollar value thresholds between the small, mid, and large cap categories. If you didn't know this already, market cap is just the total dollar value of all of a company's outstanding shares. You can see that with this criteria, SCHD could theoretically hold some small caps, and in fact, historically, the funds had allocations of roughly 3% in small caps, but today it's more like between 0.3 and 0.7%. But with this, you understand that the index tends to tilt heavily towards the mature, mega cap, and large cap companies with little to no exposure to small caps. Now, small caps are their own universe in and of itself, especially for younger investors when you think about how small caps have historically provided the best returns over the long term, but that's a discussion for another time. Let's continue. Those first 2 criteria we can refer to as the gatekeeper screens. A company must check these first 2 boxes to even be considered for the index and subsequently the fund SCHD. Now, after the companies pass the gatekeeper screens, the index then filters them through 4 key financial metrics, not in order by the way, but just simultaneously, and then assigns each company a composite score based on these metrics, ultimately deciding on the top 100 ranking constituents to represent the index. And these 4 key metrics are cash flow to total debt, return on equity, dividend yield, and 5-year dividend growth. Indeed, these filters have helped SCHD manage an impressive annualized dividend growth rate of roughly 11% since inception. Okay, so the first 2 metrics are pretty straightforward. A company ranks higher if its cash flow to total debt ratio is high. We want to see that a business's cash flows from normal operations are enough to cover its obligations, including shorter-term and longer-term bank loans, senior notes, corporate bonds, capital lease obligations like rent, etc., because then it's less likely to be forced to cut its dividends when times get challenging. With regard to return on equity, of course, a company should be profitable, but the more efficiently a company's management team is able to turn shareholder capital into net income, the higher it ranks. Now, these next two metrics are what you're probably more interested in, the dividend yield. Simple enough, the higher the dividend yield or the current payout relative to the stock price, the better. This is actually what I see as SCHD's biggest weakness as a long-term investor, and we'll talk about why in a minute. But finally, you have the 5-year dividend growth rate. This is what we ought to care about as long-term dividend investors. It ensures that companies aren't just paying dividends, but actively increasing it over time. Companies that are increasing their dividend payouts at a faster rate will rank higher on the list. Now, once these composite scores are assigned and the holdings list is narrowed down to 100 companies, they are then and finally weighted by market cap to represent the actual index and therefore the holdings list for SCHD. Quite a lot to digest there, but just a couple more things to cover here. Now throw in the fund's rules of no more than 4% of the entire fund in one single stock and no more than 25% in one single sector, and you get the added benefit of near guaranteed diversification. This brings us to the next section, which we'll call the purge. In other words, SCHD's annual reconstitution. You can think of it like the fund literally cleaning itself out, and it does this every March. Any company whose fundamentals deteriorate and cause it to fall in the ranks per the 4 financial metrics we just discussed are dropped without hesitation, and a new company or companies take its place. Now, what would it take for a company to fall off the index? If the company's debt spikes, ROE plummets, its 5-year dividend growth rate slows, or it pauses or eliminates its dividend altogether for any reason, then it gets flagged for removal. Now, we mentioned this reconstitution happens annually, but did you know that SCHD will sell shares of a company whose share price sees a dramatic spike up at other times of the year? It won't drop the company completely, but the fund will rebalance, and it actually does this quarterly to realign with its single stock cap of 4% and single sector cap of 25%. A lot of funds do this in a similar fashion. It just ensures that the fund locks in gains from its winners and buys into its losers, quote unquote. It's this systematic, unemotional buy low and sell high mechanic that theoretically would provide SCHD's lower volatility and downside protection. As loyal SCHD followers, you're probably aware of the last 2 reconstitutions being some of the most dramatic reconstitutions we've seen recently, but the specifics aren't important for the purposes of this video. Now we get to talk about why SCHD may not be a good fit for some investors. I see a lot of investors using SCHD as their means to diversify away from the S&P 500. But did you know that on average since inception, 80 to 90% of SCHD's specific holdings are also found in the S&P 500 index? Wait, what? The fund overlap site here says that there are only 46 overlapping holdings between SCHD and VU as of July 2026, with over 8% overlap by weight. So what in the world are you talking about? What I'm talking about is when you take into account how much SCHD actually allocates into each of these 46 overlapping companies as of today, they make up between 85 to 91% of SCHD's total assets. The rest of SCHD's holdings that don't overlap with VU actually make up barely 10% of SCHD's portfolio. And the 8% overlap by weight you see on the fund overlap site here is because they make up a tiny fraction of VU. So really, you're not actually diversifying. You're only diversifying in the sense that you're overweighting the underweighted holdings in VU whose gains or losses would otherwise be drowned out by the high concentration in VU's top 10 companies. Now, of course, overlap between funds in a portfolio isn't always a bad thing. I mean, number one, let's not even compare SCHD with its rival VIG. In terms of overlap with VU, VIG has 166 overlappings with VU today, or 40% between the two funds. So in the case of pairing VU with SCHD, I actually think it's a reasonable strategy to pair a broad market index fund with a fund that focuses on certain factors like dividends or value or quality or higher free cash flow yield, whatever. I've also heard investors say that they use SCHD to intentionally allocate away from the tech sector into other sectors like consumer staples, utilities, financials, etc., etc. So it's a reasonable strategy if what you care about is equal weighting between sectors, but there are better, more efficient ways to do that. Check out these two ETFs here. But anyway, let's bring it around to SCHD's financial metric filters we discussed earlier that you probably care about the most: the dividend yield and the 5-year dividend growth rate. Now consider this. Even before the 4 pillars are calculated, the index ranks the entire eligible universe of stocks by raw dividend yield and automatically drops the bottom 50%. I mentioned earlier that I saw the tendency to favor a higher dividend yield as a weakness. Here's why. A company with a lower starting dividend yield is mathematically more likely to grow its dividends sustainably over a longer period of time. If the index that SCHD is designed to track automatically dismisses companies that have a lower starting yield relative to their peers, it's either doing so because the stock price has seen such a spike up that its dividend yield gets reduced just by simple mathematics, or because its dividend yield simply isn't satisfactory compared to its higher yielding peers. The main problem with filtering out lower starting dividend yields is that investors miss out on companies with a stronger potential to reliably grow their dividends over time, which is exactly what would provide that massive dividend compounding effect that we're ultimately shooting for. And speaking of reliable dividend growth, here's what might be a shocker, at least it was for me. The cash balance of just one quote-unquote growth company like Alphabet or Amazon is larger than the cash reserves of the top 10 holdings in SCHD combined. Did you see that one coming? And here's something you really need to think about. If you look more closely into the traditional dividend-paying sectors that SCHD tends to favor, including utilities, energy, and heavy industrials, companies in these sectors often run on highly leveraged business models as they issue corporate bonds to fund capital expenditures, which means they count on cheap debt, let's call it, to leave enough free cash flow to pay for their dividends. And I'll give you a real example of this. Chevron, which SCHD currently holds today at 3.9% of its portfolio, can sometimes rely on debt to cover dividend payouts during severe commodity downturns. We saw this during COVID. Oil demand had crashed and prices fell into negative territory. Chevron's free cash flow tanked and actually turned negative at a certain point, and so they increased their debt to capital ratio temporarily to fund the dividend and sustain core operations. Now, here's the important question. Did Chevron get dropped from SCHD for its negative free cash flow? No, because it still maintained its dividend payout to keep its 10-year continuous dividend run and 5-year dividend growth rate uninterrupted. Can you see the potential problem with this? I know Chevron's just one company, but if SCHD's holdings prioritize distributing dividends to the point that they're willing to tap into leverage to fund those payouts when things get rough, can you really count on the sustainability of those dividends? Would it not make more sense to rely on companies that choose not to dish out everything they've got for the sake of a sexy dividend yield, but instead reinvest that cash flow to expand business operations? We've been conditioned to think that old school dividend paying giants are the quote unquote safe havens of the stock market. But in market environments where Fed rates are forecasted to stay higher for longer, like many analysts are currently forecasting as we speak, then the holdings in SCHD, which may be more leveraged than we actually thought, would be exposed to the risk of a squeeze on their ability to maintain, much less grow, their dividends. We've already seen SCHD's dividend volatility play out in the past. As you can see here, SCHD's dividend yield has fluctuated significantly more than that of VIG in the past decade. Meanwhile, the cash-rich tech and growth compounders that anchor funds like VIG or DGRO are sitting on balance sheet fortresses. They simply don't need Wall Street's credit lines because their high-margin operations generate truckloads of cash. In a sudden macro crash, which safety net do you want protecting your money? A mountain of cash or a balance sheet full of aging corporate debt or that requires skillful managing of leverage to maintain dividends? Think about it. I personally think there's a clear answer for younger investors in their 20s or 30s if it's a struggle between SCHD and more dividend growth focused funds like VIG or DGRO for their portfolios. I have not seen anybody claiming that SCHD is a bad fund, and I'm not about to either. I think it's a perfectly reasonable strategy for someone in retirement who's looking for dividends before selling shares as part of their retirement income, but the opportunity cost may be potentially in the tens of millions of dollars for a younger investor whose only strategy for dividends as part of their wealth accumulating journey is SCHD. But what do you think? Is SCHD still mathematically sound enough to build that dividend snowball you're looking for? Are you still unconvinced that dividend growth rather than higher yield is the primary driving factor for the ultimate compounding machine? Let me know in the comments what you think about my analysis. Leave a thumbs up for the video if you liked what you saw, and subscribe if you're craving more dividend growth discussions. Thanks so much for watching, guys, and I'll see you in the next video.